This buyer purchased their first home in Fayetteville, Georgia, and they walked in with $9,000 in equity before they even made their first payment. They negotiated seller credits to bring their out-of-pocket down, and they structured the deal as a house hack, so a tenant is now helping them cover the mortgage every single month. Let me break the whole thing down. What is going on, guys? Welcome back to another deal of the week. If you are new here, my name is Ricardo Carrillo. I run RC Lending Advisors. We're a nationwide mortgage lending company that helps clients all across the entire US get financing for both residential and commercial deals. Whether you're buying your first home or scaling your real estate portfolio, my team and I will walk you through the entire process from A to Z. The whole point of these videos is to show you real deals with real numbers about real clients and exactly how they're structured so that you understand what's actually possible when you do this the right way. This deal was a primary residence purchase in Fayetteville, Georgia, and there's a few things that happened in this deal that I want to walk through with you guys because it's one of the most underutilized strategies for first-time home buyers who want to stop paying rent and start building wealth at the same time. So let's get into it. The property is a single-family home. It's a 4-bedroom, 3-bathroom house sitting on 2,700 square feet, sitting on about an acre in Fayetteville, which I absolutely love about Georgia is you get a ton of land. This buyer was purchasing this property as their primary residence, and the strategy was to house hack. Now, for anyone who doesn't know what a house hack means, house hacking is when you buy a house, you live in part of the house, and you rent out the other portion so that the tenant is helping you cover your mortgage payment every single month. It's one of the smartest first moves a buyer can make because you're building equity, you're living somewhere, and you're offsetting your biggest monthly expense all at the same time. I've had countless number of clients who have done this house hacking strategy across all 50 states, but I really want to talk about why the deal made sense from a financing standpoint. The purchase price was $390,000. The property ended up appraising for $399,000. So before they even made their first payment, they already had $9,000 in built-in equity. That means they bought right. It doesn't happen on every single deal, but when you find a property that appraises above what you're paying for, it's a good sign that you're entering the deal with the market already working in your favor. As a first-time home buyer, we used conventional financing, which allowed our client to come in with a 3% down payment. That's actually one of the lowest down payment options on a conventional loan, and it's something that a lot of first-time home buyers don't even know exist. A lot of people think that you need 10, 15, 20, sometimes even 25% down, whereas conventional financing allows you to go as low as 3% down if you're a first-time home buyer and you're buying a house to live in. Because we purchased this for $390,000, that means the down payment was just $11,700, which is actually cheaper than most people's cars. And that's a real number. It's a disciplined first-time home buyer can actually save towards that amount of money. The loan amount ended up coming out to $378,300. We locked in a really nice 6.25% interest rate for our client on a 30-year fixed term. 30-year fixed is typically where we like to stay. Principal and interest on that came out to $2,329. Homeowners insurance was $195 a month. Property taxes at $419 a month. And PMI on this deal was at $113 a month. Now that puts our total monthly payment just a little bit over $3,000, which is at $3,057. But let's talk about PMI for a second, because this is something that a lot of buyers, they miss, and they think that they don't want to move forward because of PMI. Now, PMI on this deal was $113 a month. That's the cost of essentially putting 3% down instead of 20% down. If this same buyer had brought 20% down, they would have needed $78,000 bringing to the table instead of $11,700, which is what they brought. That difference is $66,000 in cash that is now staying in their pocket because they're paying $113 a month. It would take actually almost 50 years to be able to pay off that difference, which is insane. The math never works in your favor trying to bring in more money just to avoid PMI. I always look at it as the cost of doing business. You keep more money in your pocket, you can deploy it somewhere else, and you let your assets work for you. This is where you start to use other people's money, like the bank's money, to go buy more real estate deals. Now, here's where the deal actually really comes together. We negotiated seller credits at closing, which actually came back to the buyer and reduced what they needed to bring to the table. Now, after all closing costs, seller credits, and adjustments, the total cash to close for our client on this deal came in at $26,175. That was the down payment plus every single closing costs total, right, on that $390, keeping it just under $27,000, which is phenomenal. And the house hack is what actually makes the math of the deal make sense. A 4-bedroom, 3-bathroom house is going to give you a lot of flexibility. You could rent out a room or even a portion of the house. Let's say you're renting a separate space for $1,000 to $1,500 a month. You know, the way that this property was laid out, our client's going to be having to pay less than what they were previously paying in rent. And if you're collecting that $1,500 a month from a tenant, that's going to bring your total cost down, right? The payment on this was $3,000. They're now paying half of that to live in this place while the tenant is helping them pay their mortgage. And then when they move out, they rent out the part that they were actually living in. And that's basically the point. You stop paying someone else's mortgage and you start building equity. Your tenant helps cover your monthly payment, and every month that goes down by more than the $390,000 asset that we had already purchased here for $390K. This is how first-time home buyers who think strategically build real wealth. They do this every single year, putting 3 to 5% down, not waiting for the perfect time to buy or the perfect interest rate to buy. By finding the right deal and structuring it correctly and executing, you can build real wealth. Now, if you want to understand what this process looks like for you in your situation, you can go to rclending.co, or you can find me on my Instagram at Richie the Lender. My team and I work with buyers all across the country, helping them do exactly this from A to Z, and we can walk you through every single part of the process. I appreciate you guys for watching. If you haven't seen my other Deal of the Week videos, you can click either here or here to check out last week's. Like and subscribe to the video. I will see you guys in the next Deal of the Week.